So you think the bull market has a ways to go?
I do. I think if you look at the underpinnings of what's been driving this market, it's really been earnings growth. Now this year, earnings growth is more stagnant at a headline level because of the downdraft in energy and the strong dollar. But if you strip those out, we're still looking at mid to high single-digit earnings growth. That's going to become more evident as we go into 2016, and I think that's going to continue to power the bull market higher from here.
Then when you think about sort of the downdraft in equity prices we saw in August and September, what do you attribute that to? Global risks?
Yeah, I think there was some concern about how steep of a slowdown we were seeing in China. And it's clear that what's going on in China, we're seeing a transition, I would say, between an industrial-led, infrastructure-led economy to more of a consumer services-led economy. And that's proving to be a bit bumpy. And I think the implications that was that going to spill over to the U.S.? I think after third quarter earnings season, we can say we're not really seeing that in a big fashion. Some markets are uneven, especially industrials and certain parts of industrials. But on the whole, the U.S. economy, I think, is doing fine.
So here's my question. If the stock market is going to continue rallying, even if it isn't at the same pace we've seen over the past few years, what's going to drive it? I look at the earnings that we've seen thus far in the third quarter. Yes, of course, energy is a disaster, but even outside energy, there's negative revenue growth in materials, there's negative revenue growth in industrials, there's negative revenue growth in financials and utilities, and the picture for earnings growth is even worse. So there's going to have to be a massive multiple expansion to drive stock prices higher, barring some turnaround in revenue and sales growth, and earnings growth.
I think this is why there's an opportunity. I think there's definitely some concern that we're seeing the end of the bull market in earnings. I do, though, think if you strip out the dollar has been a huge drag, energy has been a big drag, and that energy drag has definitely bled over into parts of industrials. But I think that headwind is going to start to abate. And as we go into 2016, I think that's going to become more clear. I think in the first quarter, we're going to see headline earnings growth resume. And it's going to be not only earnings, but it's going to be revenue growth. I think that's going to give people a lot more confidence.
Matt?
Well, backed by popular demand is the EA function, the snapshot of earnings. And Eric has asked me to switch over to growth rather than surprise. A lot of times we look at surprise.
This is what I was talking about. Look
yeah, exactly. So you see earnings growth here in the energy column dropped 55%. That's not negative growth. That's a decline of of half. But you do see gains, Eric. So where people aren't spending on gas, maybe they're spending on new iPhones or telecommunication services, which are up 22%. Consumer discretionary, as David points out, maybe more people are going to restaurants. Well, consumer discretionary is up 15%.
What David's really talking about is what you see in the lower left-hand corner there, because after that vertical red line, that's what economists and analysts are looking for. They're looking for a turnaround. This is what you're predicting.
Right, exactly. And I don't think it's hard to get there. I just think, again, if you strip out some of these headwinds from the energy sector and its knock-on effects, as well as the dollar, you can definitely get there.
But how do you strip out the headwinds? Because there's those headwinds that technically affect the way these things trade every day.
Well, because if you go into 2016, the dollar, look, as the dollar stays where it is, the headwind from the dollar is not going to be an issue as we go into 2016. And if oil prices don't have another 50% downdraft, that's not going to be a headwind in 2016. So you're just getting, it's basically easier comparisons. But again, if you just strip those out right now, we think revenue growth, excluding these headwinds, is about 5 to 7%. And that, I think, is not really being appreciated by the market. I mean, to be fair, I think that's part of the reason the market has rebounded, I think. I think people have taken some solace in the fact that underlying earnings growth are still okay. It's an uneven picture, though.
What about fund flows, though, or money flows? Because what we saw happen during the quantitative easing era here in the United States is that money came in from the rest of the world pumping up U.S. asset prices, while we saw, for example, European and Japanese equity prices decline. Now that's reversed. If all the same rules hold true, shouldn't all the money be going to Europe and all the money be going to Japan and out of the U.S. market?
To be clear, we actually like overseas markets better than we do the U.S. market. So I think the overall equity bull market is still intact. But to your point, I think there is some better upside in some overseas markets. I think, look at the European.
Even with the currency risks.
Even, right, you've got to, I mean, currency is, obviously a variable, but the way I think about Europe is it took them a very long time to clean up their banking system. It's finally in a position where it can now support the recovery. this is going
Says a guy who works for a bank that actually cleaned up fast.
There you go.
No fault, no ding from my part at all. But obviously, that's a big deal now that the banking system is in better health. And you're seeing it in the lending surveys in Europe. They only started supporting the recovery about 12 months ago. So that gives me some comfort. This is going to be a durable recovery, and we're not going to have the backsliding we had in the early parts of the recovery after the financial crisis.
So what then presents the biggest risk to your view?
I think policy is still one of the biggest risks, and politics. Clearly, the structural issues in Europe, I don't think, have really been addressed, and we've seen some political backlash there. And as we go into a Fed tightening round, I think we have to be careful that policymakers don't make a misstep. And if they over-tighten too much, that could certainly be something that we have to.
And what about on the politics side? At what point do you start to begin weighing the benefits and disadvantages of a Democrat versus a Republican in the White House?
At this point, it's kind of silly season in the campaign season, and it's very hard to, really take a lot of these proposals with any degree of confidence. I mean, at the end of the day, all these proposals have to go through a Congress. So the way I would think about it, though, is that if we have a Democratic president, we're probably going to end up with kind of the status quo, and that probably
a Republican-controlled Congress.
And right, exactly. My assumption is Congress doesn't change too much. So kind of a status quo. That's going to be, investors like certainty. Investors understand how to invest in the status quo. If there's a Republican in the White House, we probably will see some attempts to make some policy changes that could make some volatility. Some of those changes could be good or bad. We'll have to assess when we get to that point.
If you say policy and politics are the overhang, how do you manage the perverse effect of central bank intervention? When they do it, the market likes it, but they're doing it because their economies are so bad.
I think the market likes appropriate.
This is Matt Miller's favorite subject.
Right. I think the market likes appropriate central bank policy. And what I mean by that is that's why we.
Hold on. Do they like appropriate central bank intervention, or do they just love the fact that a massive safety net hangs under the market? So whatever happens, well, we know Mario Draghi will do whatever it takes, or Janet Yellen will catch the baby falling out of a window. That's a nice way to invest, knowing you've got that.
I don't have that perspective. I think what's really been driving this is earnings. If you look at what earnings have done over the last, since 2009, it's really been the primary driver of this. And sometimes the economy needs more support from the central banks. Sometimes it needs less. And that's why I think the market is beginning to rally on the notion that the Fed actually will begin to tighten, because the market thinks that's the appropriate policy. So,
David,
I think
do you know what happens when guests disagree with me? I end their segments. Thank you. No, I'm messing with you. We do have to say goodbye. UBS's David Lefkowitz, thank you so much. That was great.
Thanks for having me.